All right, we're gonna start with chapter 10, all about long-term liabilities. Can someone tell me the difference between current liabilities and long-term liabilities?
Current is under a year, right?
Current is under a year. What does that mean for long-term?
Over a year.
Perfect. So just to kind of run through it, can some people give me some examples of some long-term liabilities? Bonds, notes. Which are the main focus of the chapter. There's some other long-term liabilities, but these are the biggest ones to kind of keep track of. We also kind of go through mortgage payable. But otherwise, these are the big key items. I'm gonna make sure I'm spelling this right. And just like the notes, we're gonna focus from the terminology and just go straight into notes payable. So what's the two biggest things about a note?
They're debts.
They are debts. What are the two things that are kind of tied into the installment plan though?
Principal and interest.
Principal and interest, perfect. We got our principal and we got interest. All right, what is typically our principal?
Yeah, like total amount.
Total amount, basically everything that you owe. What does that mean for that interest?
Cost of borrowing.
Cost of borrowing. Basically, the rate of excess that you will pay. Let's see. Thank you. So we typically do this in like installments, especially with long-term note payable. You're going to be paying off portions and portions through rather the year, semi-annually, monthly. I think those are the biggest ones. I almost said daily, but I think you get into that in like financial spreadsheets and not in financial accounting. So we're just going to go through annually how many times do you get interest? Once a year. What about semi-annually?
Twice.
What about monthly? That's you. So how many times monthly? 12. Now, why is this important? What does this kind of determine? Yep, how many interest payments, how much is interest compounded? What do you typically do to your percentages with this? So we'll say, for example, we'll have a 5-year note and we'll have 6%. we know right off the bat with annually, this is kind of the base rate. This is going to not change at all. But let's take a look at semi-annually. What happens to the year? How many, what do you do to the number? You do half the percentage and you do double the year. Now, we don't see this as often. I don't know if you're gonna see a problem like this, but it's still very important to know, especially going into more financial classes. But how many? I did not know if that was a computer or a lady walking outside, so I'm gonna close that actually. Is it? All right. So what are you gonna do for monthly? How many times are you gonna be paying your compounding interest through your 5 years? You tell me rather the number or how to get the number. Either one works. 5 times 12, 60. What's gonna happen to that percentage? Divided by 12. So these are very, very important to know kind of throughout this chapter to be able to separate, okay, how many payments are you making? How much interest are you getting for each one? Because then we're gonna start digging into an actual problem. I'm gonna set up a problem up here. I'm gonna get a amortization table set up. And I'm gonna let you guys work for 5 minutes on it. So once I put the problem on it, feel free to just start getting started and start working ahead. And as always, if something is illegible, this board makes my handwriting terrible. So just let me know. What I want as well is the journal entry to record the issuance of the note and at least the first journal entry to be able to pay for that interest. And this is not going to come up to a nice number because I don't have a financial calculator to make nice numbers. So we're not going to go too crazy with this. We'll probably do maybe just a 4-year note.
Is that 30,000 or 50,000?
30,000.
Okay. It's not writing, it's my eyes.
I feel that in my soul. Without my glasses, I can't see an inch in front of me. very, very rough. I'll give you guys around 6 minutes since I had to fix some things, but otherwise after 6 minutes, we shall get started. If anyone has any questions, feel free to let me know.
What's the cash payment say?
So the cash payments are 4,000.
Okay, thank you.
Yeah, of course. I know I kind of like squeeze that one in there too.
Again, it's just.
You'll have like 3 more minutes. Welcome in. We are working through note payable problem.
No, sorry.
We're working on notes, so we're still at the very
Okay.
beginning. We got 2 minutes left solving this guy, and then we're gonna run through it if you want to try your hand at it.
on the right track right here. So there's the issue.
So, good question. How do we get your next pay? Yeah, that's where it's a little iffy. You're on the perfect track, but I think relook where you got that 900 from.
Yeah.
And where that usually is. And how do you get your interest expense?
This.
Sometimes, so we did a calculation for that. Okay.
What do you want to surround you?
Huh?
What do you want to surround you?
Just round, make it whole numbers. We'll make it easy. So, is that how you get your net payable or interest?
Interest. I got that.
Otherwise, everything looks great.
Thank you.
All right, we're gonna just start running through this thing. I know not everyone's probably done, but I want to make sure we're able to get through everything. So, first off, how do you get the journal entry for at issuance? Cash and no payable, what's debited, what's credited?
Cash is debited.
Cash is debited, how much? 30,000. And note payable. Same thing. So, before we get to the journal entry for the payment, let's fill out this chart first, because this is going to give us everything we need to know. For chapter 10, these amortization charts are like the soul of every question, because this will give you every answer. So first off, what are the 4 categories that you need to use to make an amortization chart?
Total cash, interest, principal and ending balance.
Perfect. All right. So we started off, I should have made like an extra little date here for like where we started off at 30,000. We're just gonna toss it over here with Jan 1st right next to it. We know where that came from. The reason why that's important. I know. Cash payments, we were given, so we're just gonna toss it down on here. All right, so first things first, what do I do next? $30,000 times 0.03. So it should get us 900. Now, how are we going to find our principal? Subtracting. What's going to happen to our carrying value?
Wasn't it semi-annual?
It is semi-annual. So I have June 30th and December 31st. So
0.6% if you're going 12% interest, or am I looking at this? It's 6% interest?
get 6% interest.
Okay, all right, sorry.
They're all good. So then after that, let's see. Welcome in, we're working on a note payable problem. All right, so we know our carrying value is going to decrease. Gonna bring that to 26,900. All right. Next payment. What's happening? Same thing,
Oh,
What
wait,
about the
no.
new carrying value?
same thing, new carrying value. Same thing gonna happen to our principal?
Yeah, just say-
Exactly, we just keep bringing this down. Last things last. We're gonna bring down our carrying value, right? All right, y'all wanna just start calling off numbers on here to fill? Huh?
Next one?
Yeah.
700.
7-Eleven. Just bring it down the line. All right, what about the next, what about the last one? 613? And so on and so forth. Basically, keep doing this, rinse and repeat twice a year.
Well, the funny thing of it is the way that it's drafted mathematically, so that you can see your interest rate going down and your principal going up.
Oh,
Is more of just a play on your brain to an incentive to pay it off, because you could do an equalization amortization chart where your interest and principal remain the same throughout the pay period, but it wouldn't give that boost to your brain power that I'm actually accomplishing it, when in fact you're accomplishing both things.
Yep. No, it's always, I love these things. I've learned to love these things so much. They're useful. You guys can use them in your everyday life, even outside of class. Now, besides that, it's very satisfying and it does trick the brain into, we need to pay this off faster. What is very important about an amortization chart? What is the 3 things that basically tell us what we need for an interest payment?
In some cases, it's non-taxable.
True, yeah, it's not tax, actually, you're able to call, you'll learn this in tax class, but you're able to call your interest expense off, and actually lower your taxes by it.
Everybody helps.
So, how do we set up a journal entry for the interest payment? Yeah, what's debited, what's credited, and we're gonna take the numbers from June 30th. Payable first. And what number is note payable? For the journal entry for June 30th, X1, so this guy. 3,100. All right. What next? Interest expense? Debit or credit? Debit. Perfect. Now, what does that leave us? Credit to cash. Anybody have any questions on this?
Actually, we have.
Yeah, of course.
I think Professor here taught this totally different way. It's just the order. Yeah. Yeah, I'm looking at trying to figure this out.
Do you mean like the order of the amortization?
Yeah, just like the top rows.
The reason I do it this way is it makes sense to me because that way we're able to put it into like an equation.
Yeah.
Because you take, your cash is always gonna be your, except if we're talking about a bond problem. Your cash is always going to be kind of like your anchor account, because that's gonna tell you, okay, how much am I splitting this into the principal and to the interest?
Mhm.
That's kind of why I set it up like this, but as long as you know that, but let me take a look.
This is how she has it set up. I remember notes right here.
Okay, the only difference is that she puts the beginning balance too. Like otherwise, it's just everything's,
Yeah.
yeah, beginning and ending. And then you have the interest, you have your note payable, and you have your cash. Hers is set up in a way that she wants you to be able to see how it is in the journal entry. And be able to see, all right, we're decreasing this balance. So it's not, the method's still the same, it's just that she has a different chart. Does that make sense? Awesome. But besides that, does everything make sense? Awesome.
Yeah.
All right, so before we go to mortgage, I want to ask, what's going to be the main thing that you want to do for a note payable? What's your ending goal? And it's very simple. Get a zero. Basically, we want, at the end of this, we get to year 7, do our payment, our interest, our principal, and we take this off to 0. I believe you won't have to plug anything in. I know for like the homework with Connect, you had to plug like the last number in for some problems. But I believe on the test it should even out. But your teacher will let you know either way. But at the end, you just basically want to know, we want it to 0. All right, let's keep going. So we'll start working on a mortgage problem. Is there much of a difference between a mortgage versus a note? Basically, the only different is the assets. So, and it's a legal title to property. So that's like the big difference. For a note, you're typically going to be buying a car with it, big ticket items, but you're never going to be buying a house with a note payable unless you're borrowing money from the bank. But a lot of times you're going to be doing a mortgage for like things like property.
A 5-year car note versus a 30-year house one.
Yep. Gotta love it. All right. I'm gonna give you guys 6 minutes, just like last time.
This lecture or this thing will be posted before Monday.
Yeah, no, I'm planning to post this and as well as Wednesdays today.
Oh,
I just had to edit through Wednesdays since we had all the issues and I
Mhm.
wanted to make sure I like to condense it. This one, just like usual exam study ones, I try to post out the moment that I get the recording footage. It's usually just regular group studies I take and edit.
yeah.
That as well. Are you in Miss like Blockers or Jaeger's class?
Yeah.
Jaeger's. Okay. I sent out all the blue kits and
Mhm.
all
I
the
got
study.
that email.
Always glad to know who gets out.
Yeah, no, I got it right before this.
Guess worse.
Yeah, we do that. Yeah.
We're doing a mortgage problem.
You have a spare mark?
Yes, we have. Okay. We're working on mortgage. All right, looks all good. So the one thing is though, with this, we're not purchasing the cash on mortgage payable.
Yeah, issues, that's the one.
That is an issue, that is typically for issuance, but this is specifically for the purchase. So you're gonna have to consider the land and the building as well as your house.
Oh, I can include it again.
Yep, so you won't be dealing with cash at all, because we're not technically getting cash, we're technically getting the building.
Land and buildings. Oh, okay.
This mortgage?
Yep, this is mortgage.
That's the last one, right?
It was the second one.
Second one.
Bonds are the last one.
Okay.
So we went through notes, we're going through mortgage, and then we're gonna get into the fun territory of bonds.
Do you want to still like do the full table?
We're just doing, I have an empty table here. We're just doing like 4 entries. So as long as you're able to get through like the first 2, you'll be good. We're gonna start answering this and I'll give you guys like 2-3 minutes.
See if we're good.
Yeah. Sadly, we only get like 2 hours in this room, so we're just gonna rocket fire. That's why I made chapter 9 and 6 a focus on Wednesday. Yeah, and I think that's the reason that you want that. You should be something like 7, right? This one's, yeah, just, we're rounding up. Make it easy on y'all. That's good. Yeah, looks all good. So Yes.
What is it, interest expense?
So it should be, when you divide 9 and 12, it should be 0.7, well, not 0.75, but it should be something 7. I'm doing that by the whole number. So let me do that.
Trying to check those out.
No, where's?
6.000. Oh, you have to divide 9, 9 divided by 12.
My poor folder. So it's total cash payment interest expense.
Yes.
You said that's right.
I think I'm wrong.
Yes. Oh, yeah. Okay. Yeah, you're missing a column and I got.
XP.
Yeah, I messed up that one.
So I'm like writing it up.
Dang that, wait.
We're gonna be running through this and we're able to get.
Oh, I got that. Yes, I got it correct.
That's. I know Miss Akers went through more, like for a note. It's basically the same thing as a note payable, just with 12 issues, 12 payments. So as long as you know how to do a note payable, you'll be able to know this. We'll run through it either way.
Alright, so the long term since you have and then cash, the down payment has a credit. It's and I mean, yeah, what?
Yeah, looks great.
Yes. Yeah, I skipped a whole part. I was like, when's the bar? To this one.
Yeah.
Is that
So
number?
this one, you're gonna still have to be dealing with
Interest rate.
interest. So you can figure out what the interest is. So when we're doing monthly, what happens to our annual interest rate? Perfect. You get that, and what do you do? What are you gonna be counting that to figure out your interest? Now you're gonna be taking it as a whole, or you're gonna be times it by your carrying value, or you're gonna have to write cash. Carrying value, because that's what's gonna be gaining interest. Whatever you owe, whatever debt you still hold, is going to be what's gonna be earned on. Yeah. And then after you do it, and then when the second payment comes, you're gonna get the new carrying value. So we're gonna run through this now. So we can say what I mean. All right, we're gonna go through this. First things first, what's gonna be the journal entry for acquiring this property? So that'd be usual for a note payable. This is the one difference that this has in a note payable.
Oh,
So what are we gaining?
Building and.
Building and land. And do we add the cost together or do we keep it separated?
Together.
You're actually,
I would say we're separated.
you're gonna have to keep them separated because what's the main rule about land?
The depreciation schedule.
Yes, no depreciation schedule for land. So you wanna make sure that you keep your building and your land separate. This kind of harks back to chapter 8. So we then credit the cash that we did use for it. And then whatever is left is basically our mortgage payable. Now, we're not gonna go into the first payment like last time. We're first gonna work on our amortization chart. Now, there's not too much difference between this, and we're just gonna do this payment, 1, 2, 3, 4.
What was the last one besides cash?
Mortgage payable.
That's a debit.
It's gonna be a credit. Because that's gonna be your liability. So we have a cash payment. We got interest. We got principal. And then we have a carrying value. Which it starts off at 380. 380,000. So where we got the 380,000 was actually from figuring out, okay, how much cash did we pay down and how much did we still owe? So if we look over here and we add up our building and our land, we should get that number of 456,000. And you subtract it out that cash payment that you put down, so your down payment. When you subtract that out, you should get 380,000. So does the cash payment change at all, or do we just have a stable cash?
Oh, staple.
Stable cash.
And then I'm just gonna-
And how are we gonna find, so we know we have a 9% annual interest rate. Is that gonna be our interest rate that we're gonna times by?
No.
What are we gonna do?
Oh,
Divided by 12. Which you should get 0.0075 as your interest.
okay, yeah, I'm gonna see, I'm gonna let this go.
Yeah.
Because I hope I did this right.
So what are we gonna do with that new interest rate?
Multiply it by. Let's see if we
Would it be 4,500? So what are we gonna multiply this by?
Oh, you're 384.
380. We're gonna take that 380, times that by our new interest rate. And that's gonna get our first interest payment, which will be, oh, wait. That's why this is off, because that is not the right number.
Wait, no, the first line's blank, right?
Technically, yes, it should be blank, and then you have your carrying value, but I keep forgetting to add a space, so I put it there. So,
Is this one for the October one, I guess?
yeah, this is for like October, so this is like the first payment. So we have the first payment, second payment, third payment, fourth payment. Here, actually, I don't want this to be confusing, so I'm gonna stop being lazy and put in another line.
So for the first line, cash, I just put transfer spelling accident.
You have an accident, or you can just leave it as it is. This is kind of like on day, this is our carrying value.
So should we wait that?
This was 2850. Anyone have that principal payment for me? 1,650. And how about that new carrying value? 178,350. Now, what's gonna be our next piece of interest? How are we gonna find the next piece of interest?
0.37, the 378,350 by 0.09 or
Perfect. Real quick. The calculator says this is 150, not 350. Okay. Let me be sure. Oh, yeah, right. Yeah, because I'm doing this wrong, that's why.
So it's 350?
Yeah, it's still free.
Okay.
I swapped my numbers.
Wait, no, round this to the hundredths place, right?
Make it a whole number. We're making this easy.
Making those whole numbers?
Making a whole numbers. So next one is
3.
2838.
Oh, it's 1,662.
Perfect. And what about that last one? What's our new carrying value?
376,600.
Let's see.
Yeah, I'm not too going in and doing that. Yeah.
And then we just keep rinsing and repeating. So our interest keeps going.
And do the whole, interest will keep going down, right?
Yep.
And, principal payment will go up?
Yep. That's what Richard was saying earlier. It tricks the brain because it looks nice, because your principal looks nicer and nicer, and you're paying off more and more while your interest keeps going lower. So it kind of incentivizes you to pay off more and pay off faster. But is there any questions on this? Or is it making sense? This is a meaty chapter. If something doesn't make sense, let me know. All right. I'm gonna put in the last couple numbers of us here, and then we're gonna move on to our favorite bonds.
Yeah.
Yeah.
What's the, it's bonds, mortgage, and
Bonds is kind of like the biggest part of the chapter. Notes and mortgage kind of tie together. That's why they're very similar. That's probably why Ms. Walker doesn't teach them.
yeah, so they're pretty much in the same way on mortgage and those people.
Yeah, basically same way. It's just typically the difference is what you're using it for.
Okay. Hey, you forgot.
And that's also why like the practice problems in this chapter are so integral. Like when you guys go to study this weekend, practice them 2 times, 3 times over. Like I highly recommend just going through them over and over because the method is the same. So, what's the goal for a mortgage payment as well? What number do you want to get to at the end? 0.
Wait, I thought that you.
Want to get to nothing. Now, what's our first payment entry going to look like?
Credit cash.
Credit cash.
Have a good one. Me too.
Now, your credit or debit mortgage payable?
Everything.
Debit mortgage payable, and what's the number we're using?
I erased the numbers.
Well, we got the numbers up here.
16
Let's see.
digits. That's fine. It's the
Principal payment for
1650.
1650. And then we have, what's the last one?
Interest expense.
Interest expense.
It doesn't matter what's on top, right?
Does not matter, as long as you got your debits for your credits, that's the number one rule. If your interest is swapped with your mortgage payable, doesn't matter. It just matters if you have them in the right order. So. And the interesting thing too, is if you look through this, you're able to kind of really see what's happening here. So we know our assets are going down. We know our liabilities are also going down. And we know our net income, or technically equity, is going down as well. So we're able to see, all right, all of them agree to each other, which is how it should be whenever you're dealing with assets against liabilities or equity. So we're going to keep going to here, and this is where things get incredibly into terminology.
This is sponsored.
This is bonds.
Okay.
Yes.
So if you made us do like a line, do we have to know how to pull this out?
Let me see. The bond certificate. It's nice to see it, but I don't think you guys are gonna need it for the test. It's kind of just to show what it looks like, because each of these are different forms of liabilities, different forms of payment. You typically have like the note, which is like a very, very formal way to say I'm gonna pay you. Mortgage payable as well. Basically, I'm gonna pay off this asset. Then you got bonds payable, which is basically, hey, can I have some money, please? I'm gonna make a project in my business, or something like that. So bonds payable. Projects are often financed with bonds for both for-profit and nonprofit companies, government units, etc. Bonds are a written promise to pay the par value of the bond with interest and are considered long-term debt that is issued sold to bondholders. So there's two huge differences between bonds and mortgage/notes. Can anyone tell me what they are? So what number do we typically try to get to when we deal with a bond?
As, well,
The par value. So bonds, typically we want to get our bond equal to that par value at the end of the day. What does that also mean? What typically are we dealing with instead of a principal? The ending value can go up or down. It depends on one factor, which is what two types of bonds do we typically deal with?
discount premium.
Discount or premium.
You won't be worrying about just bonds for the test.
I don't think you will be dealing with par bonds, but if you are, we'll run through an example of a par bond as well. We're gonna go through the par, we'll go through the par first, and we're gonna go through a discount and a premium. But the biggest thing to know with par is like interest is equal cash. And with discounts and premium, you're gonna be not dealing with principal, but you're gonna be dealing with whether it's a discount or a premium, and trying to basically make your bond agreeable with the amount that you're gonna end up giving at the end. So what does it mean to have a discount?
Our market rate is higher than the rate we say,
Yep.
the contract rate.
What does that mean for the premium?
Higher.
And typically when we have pars, it just means the market. Mhm. Funny real quick. So this is something very important to know for the test, because you do need to know how to classify whether a bond is at par, discount, or premium for both the Yeager and Blockers tests. So knowing how to be able to figure out one from another, very good to know. So, have a good one. So there are some advantages and disadvantages of issuing bonds versus issuing stock, because typically companies can finance things through stock as well, but there are very big differences. The advantages typically is that the debt does not dilute ownership. Basically, if a company issues stock instead of bonds, you're getting stockholders. You're getting people that once they get a big enough piece of that pie, they're able to say, I don't like what you're doing. Let's change to this direction. Alternatively, when you have a bond, it's typically, all right, you do your thing, I do mine. I got what I need, and I'll see you at the end goal. So, an interest expense is tax deductible, which is very, very nice once you get into taxes. So disadvantages is you must have cash to make interest payments and pay back par value. So not only are we not typically paying off this debt, we are saving it off till the end, where we're making these continuous interest payments, but we're never really paying the debt itself. Instead, at the end, we get a little nice package tied up into a bow saying, here's all the money back. Does that make sense? Awesome. So there's a different way to kind of figure out the interest rate as well. But we're going to talk more about that with doing an example ourselves. So we're going to leave this up here. Everyone.
Semi-annual, right?
Yeah, semi-annual. What's a semi-annual? We're not going to do an amortization chart for this guy, since it should be pretty straightforward, but we will once we get over to the other two types. This is just gonna be kind of a good starter run. I'm gonna give you guys just 3 minutes because we only got 30 minutes left and I wanna run through both a discount and a premium problem. The last word is retiring. Let me make this look nicer.
Did you ever do like trick questions?
Would I do trick questions?
Yeah.
Right now we're just kind of doing straightforward questions. Usually on more general studies, I'll do more tricky questions just because we have more time to play around with it.
So this is a trick question.
This is not a trick question. This should
It's three different.
3 different journal entries. First, when it's issued. The second, when you're making your first payment. So like your first interest payment. And the third is going to be when you're retiring that bond. You will need to know these specific journal entries for the test. And this is universal for both classes. You're a accounting major. You're gonna have to intermediate 2. When we get intermediate 2 is where you really dig into bonds. You get to learn a lot about it. Got a question?
Yeah, I just, when you said that, I was just saying, it's difficult for me in this class. The second portion will be equally or greater than the difficulty.
Well, you're not an accounting major, so you
No,
don't have to go
business
through. Yeah, you're business. You don't have to go through intermediate 2. Intermediate 2, toughest accounting class I've ever been in. Wonderful teacher, absolutely fabulous teacher. But no, that material was the toughest I've ever went through. And we go through bonds. We go through a lot about bonds and leases. And also, yeah. Leasing both property and also leasing equipment and what that looks for everyone's journal entries. It's fun. All right, we're gonna start going through this. First things first, what's the journal entry for when you issue this bond?
Debit cash, credit, non-payable.
Yeah.
For the full amount?
Yep.
For 1,400? Yes.
Yes.
Sorry.
Should be for the full whole 20,000.
Yeah.
This is gonna be universal for both premium and discounts as well. Anytime you're, well, no, actually, no. When you are dealing with premium and discounts, you have a different issuing journal entry. Don't listen to what I said. That was crazy. No, just for this
You would
one,
just- For like discount or premium, you would just add like, whether it's a discount or premium to that first one, right?
yeah, whether you're dealing with discounts or premium, that's just gonna be added on, tacked on. So now we're gonna go on to making the first payment. How do we figure out how much we need to pay? Yes.
Unrelated, but do you think we could get away with abbreviating bond payable as BP?
Yes, you can.
Okay.
I'm just spelling it all out just in case. But no, like honestly, especially with accounting majors, everything's abbreviations. If you look at any page or any teacher's notes, it's just full on abbreviations. So feel free to abbreviate as long as you everyone knows what you're talking about. So how do we figure out the payment?
Multiply, yeah, 20,000 by 3, multiply it by 0.03. Because it's the same,
Oh, is
it's
that interest
semi-annual
rate
payment.
annual? Is that for the year?
Yeah, that's for the year. So you gotta divide it by 2.
Wait, if you just like divide your end amount, does that mean it just flows kind of start?
I would not do that. Better safe than sorry.
Fair enough.
So we got 700. How's that journal entry gonna look?
Interest expense 700, cash 700.
Gotta love bonds at par value. They look so nice. All right, so how do we write the journal entry for retiring the bond?
Flip bond, payable, and cash.
Now, this is the one that's universal. This is the one I was talking about that's universal. Anytime you're retiring your bond, no matter if it's premium, discount, or par, it will always be this for retiring. Remember that. It's always just debit, bond, payable, credit, cash. We're done, we're over, we can forget about it. New day.
Did you get a new chat?
Huh?
Did you get a new chat?
I got it right here.
Oh, okay.
Yeah, no, I'm using, especially because the Wi-Fi's been funky the last day. Thankfully, with this classroom, I can use that computer to record. Otherwise, we have issues like I think the first group study I recorded where I had to like re-talk over a section because it was just it recorded this, it did not record anything else. So anyway, I want to spend 15 minutes on a discount problem and I want to spend 15 minutes on a premium problem. Through those, both of those times, if you guys have any questions about bonds, feel free to talk about them while we're solving these through. But so far, do you guys have a good understanding?
Yep.
Oh, by the way, there's gonna be booklets available. Right?
Sent them out already.
Okay, good.
So we got 7 blue kits. I've sent them out now officially to both classes. I'll give y'all 10 minutes.
Wait, how many grams do you want to make?
Hmm?
How many grams do you want us to make?
We're gonna just work on 3. So work on 3 on the amortization. Contract rate is 8%, market rate is 7%. These were sold for 103.24, 50,000 bonds, 3 years with semi-annual payments.
$103.24.
103.24.
Test.
Hmm?
I wish this was an open test.
You wish this was not part of the test?
This is an open note.
Oh, if it was open note. We're just running it for the best of this. This would be on the top of my head, so. So we're gonna make, wait, one's gonna be based off the carrying value, one's gonna be based off of the par value. So the carrying value, what have we been using this for? The interest was payments. So when we're done, like next year, how do we use that carrying value? The cash payment. So we typically have 2 different versions. Cash payments, we usually just give them to us. Interest expense.
She wants to run this. She wants to run this again.
Both of these are gonna be using 2 different.
Yeah.
Rates. One's gonna be using the contract, one's gonna be using.
Yours dollar?
Yeah, here's one.
Oof.
Exactly, we're doing it, this is what we're doing. Is that gonna be, is that number gonna help or change? we're gonna change the part. Round up. So then here's on Navy's test, I remember last year, and this year, everything shows, you should be around, Yes, we just keep that forward. That's gonna be payment one, so then it's gonna be working on payment two. Just go on the-
It's back up to the market rate. Market rate. Dang it.
That's what I mean.
I think I figured it out. I was trying to figure out how.
Yeah, that's right, messed up.
Yep. Okay.
Yes. One. Don't be.
All right, Alec, I'm gonna give you 4 more minutes.
Yeah, I messed up.
Yeah.
Yeah.
Oh, no, you're good.
For the whole number for this, would that just be 1,800?
Yeah, just 1,800.
Gotcha. 1,700.
Yeah, because we gotta get 50,000. So I don't know what the numbers are saying.
All right, got 1 more minute and then we're gonna start running through this. All right. So, what's gonna be our journal entry and how are we gonna get it? Because this one requires a little more math than the last.
First multiply 40,000 times.
Yep. You take this 103.24 and basically make that into a percentile. And what was the number we all agreed on?
1,020.
51,620.
Oh,
51,620. That is the premium.
yeah.
So how do we make our journal entry now? What's our cash? What's gonna be our bond payable? And what's gonna be our premium? Cash is always going to be the number that you get. What's gonna be our bond payable? 50,000.
This is for the journal entry?
Yep. So one side to always know if you're dealing, there's obviously many ways to figure out if you're doing discount or premium. Obviously, if the market's high, if the contract's higher than the market, we know it's premium. If we're dealing with a percentile that is over 90, not over 90, over 100, we're dealing with a premium. Another way is knowing that premiums, their normal balance is a credit. And I like to say premium payable because whenever you're accruing a premium, it's going to be on the same side as the payable. All right. So we're going to skip over the first two things first, the other journal entries, and we're going to instead work on this amortization chart. So
I've got this.
that's okay. So what's going to be our categories at the top here to work through?
Interest expense, cash payable, discount, carry value.
So you know our carrying value is 51,620. We don't have any payments or any of that for the first year. So first, how are we going to find out our cash payment?
Multiply the par value times contract premium.
Par times contract. So in this case, this would be our 50,000 times, do we use the 8% or do we do something to it? Do something to it. What are we doing to it? Divided by 2. And we get out of this 2,000. Do our cash payments ever change?
No.
All right, interest expense. How are we finding interest expense? So how do you find that out? I think you're right, but how do you find it?
Multiply your carry value times market value.
Carrying value times market rate.
How about
Very good. So we take that 51,620, we times that by the market rate. Again, do we use the 7%?
no.
Divided by 2. And we're rounding all of these up to whole numbers. So we got 1,806. Wait, no, not 6, 7. Usually round that up. All right. So what's gonna happen to our premium? How do we find a premium?
Oh, yes.
Subtract it out. Now, what are we gonna do with our premium?
Are you gonna subtract that from carry value?
Yep, subtract that from carrying value.
I just got rounded Just like, make sure I remember, just expense market
Mhm.
rate, not contract rate.
Think of it this way. One of the better ways that I've always remembered it, par and contract rate, that's gonna be on the contract. Those are the two things you're gonna find on the contract. Carrying value and market rate, technically, that's not on the contract. So that's how I remember to separate them out, but that's my own little way. So we just keep rinsing and repeating. So down here, we now have 1,800, 200 off the premium. I filled out the chart because we're running low on time, so I want to make sure we can run through a discount problem real fast. What's going to be the first payment? What's that going to look like?
Interest expense, 1,807.
So the payment's going to be 193.
No,
Premium.
Cash will be 2,000.
Yep, cash is going to be 2,000. And then retiring, we're going to make this journal entry right here. How do we retire this bond?
Reverse.
Yep, basically, bond payable will be 50,000. Cash will be 50,000.
Very, very difficult.
Very difficult. All right. So let's see. And the one thing that I keep forgetting, but I really want to make a point of, I know I mentioned it, but I just want to highlight this. With every amortization chart you do for chapter 10, this is your journal entry. This is your guide. This is going to tell you exactly the steps you need to do it. So always remember your amortization chart. So I'm going to just use the broken framework of this to make my discount problem. So
What was the math we did to get the 1,807 for the interest expense?
carrying value times the market rate.
Oh. Yeah. There we go.
All right, I'm just gonna give you guys 5 minutes to get this started and we're just gonna run through this. We're running low on time. I think I'm gonna be losing the room in technically 7 minutes, but we're gonna try to push it 5 minutes over.
95.6.
95.6.
Oh, wait. 8%. Minus 10.
Thank you.
Have a good one. So real quick, for Ms. Blocker students, there's no study guide. I sent the blue kits, there's no study guide though, but her drills are basically her study guide. So make sure just to practice those drills.
Marcus
Also,
brings
she said for sure that like we're not doing it harder on the test, it's either gonna be discount or premium.
Discount we add, right?
Yep. Basically, the trick is whatever number you're trying to get to, you're trying to get to. So if your number is too big, you have to bring it smaller. If your number is too small, you gotta bring it bigger.
We don't mess this up. Okay, that missed that.
Oh, if you need to, we're going to, I'm going to post this up on the YouTube. So just use that link. That's going to be where all of the exam reviews and any other group study we ever do is put up. Yeah, of course. I should have both today and Wednesdays posted up tonight. As long as nothing else goes wrong. Bye, have a good one. Yes. Yeah, real quick. Then I'm gonna actually get started on this bad boy.
I just wanna see if.
So. So real quick. The payment is off. What are you using to find out your cash payment? So your cash payment for your interest.
This time.
So, that is the right way, but not with that number. So you have to remember, you're gonna be using each one separately. So you're not gonna use carrying value for both interest and your cash. Typically your cash is based off the contract. So think of, you wanna use everything from the contract, which is the interest rate and
I wouldn't use this number for.
nope, you only ever use it for your interest. Otherwise, you might wanna look over the interest as well. See, it should be a different number. We'll run through it, yes.
For, that number looks wrong.
You're close. I think you just went one decimal too far. All right,
Two,
we're running through this because we don't got time.
it's 50,000.
So I'm just gonna explain how this thing works. That way we're just gonna get through
Oh,
this.
that's right. I missed that.
So first things first, just like a premium, we're gonna take that 50,000. I'm gonna take a different color. Gonna take that 50,000. Times that by that point.
0.93. Yeah, that's where I messed up.
And you'll get 47800, which is your carrying value. And also is going to be what you're going to be using for your issuance. So we got a debit to cash. We have a credit to our bond payable. And what fits in the between is the discount. And debit discount, that's what I always think. Any questions so far? All on the same page? Got it. I know I'm just kind of like rushing through this, but at any point I will stop to explain something. So as before, we times our part times our contract rate. We did not change our contract rate, so we still have that 8% semi-annual. So you do 50%, 50,000. That's 0.04, which should get you 2,000.
Yep.
And your cash payment never changes. Now we go to our interest expense, which does change. You will always use your contract times whatever you have for your market rate and divide that by 2. So it's at 10% divided by 2 to get 2390. 2,390. Just like before, we minus it out. Except our interest expense is larger than our cash payment, which is noticeable for, we're just gonna do a discount. We then, instead of subtracting, we're adding on to our carrying value. So before we would continuously just bring down the number, in this case, we're going to be adding 390 on top of 47,800. So we're going to get 448,190. And we just basically rinse and repeat. Just gonna fill this out real quick. Any questions on this part, or is it all making sense? Got it? All right. Now to do our first payment, what's the journal entry for this guy?
Interest to, oh, wait.
So
Yeah,
just
interest
expense,
expense to 2,390.
Perfect.
then discount,
Credit or debit?
debit. No, wait, credit.
Credited 390.
Also, wait a minute. And this could be cash.
You see here, always make sure you make your journal entries even because it typically gives you the answer. If you know your interest expense and your cash are on separate sides, you'll be able to fill in the blank with whatever comes after. Now, what's going to be the journal entry to retire this bond? All right, I know we rushed through that. I'm just kind of running over to make sure there's nothing else that's incredibly crucial to cover besides saying practice. The amortization charts and everything should give you the keys. And good luck, y'all. I wish you all the best.